Today, we are doing a review and a reanalysis of our fundamental analysis for our investments in my daily stock talk program. Now, I want to talk through this and I want to go through it because I think it's really helpful to see, okay, when we're looking at stocks that we want to invest in, we want to go, okay, we want to look and say, we want to invest long term in this company. We want to know, is the company itself doing well, right? We understand that when you buy a stock, you're actually buying what are called shares, and you buy shares, which is really ownership of a part of a company. And so, if you're owning part of the company, wouldn't it be good to know, wouldn't it be good to know what the company is, what they're doing, how their stock looks, if they're making money, this sort of thing, right? So that's what fundamental analysis is all about. Is hey, let's look and see. Does the company do well? Does their future look good, right? Are they making money? Are they able to grow their money year after year? So that's what we're looking at today. So I'm going to show you guys what I'm looking at. We've got um, so here you can see the old investment analysis that I had before, and we are actually updating it. So before I looked at Ford and Kraft Heinz and General Motors and Main Street, I did not look at AT&T. That's a new one. I also switched out before I had Verizon. I thought it'd be fun to just switch from Verizon to AT&T um, for because really AT&T has a better chart than Verizon does, typically speaking, in terms of their growth of the stock price, which is cool, and I like their dividend a little bit better. Um, and so I figured, hey, let's switch and do a new one for today instead of doing Verizon's the same industry, same sector. I think probably those are the two biggest cell service providers, at least in the US. So um, that's what we're looking at, right? Doing that. So we're going to go through and update Ford. We're going to update KHC. We're going to update General Motors. We're going to update Main Street Capital Corporation, and we are going to do a new analysis on AT&T. So let's go ahead and do it, right? Should be pretty cool. So starting off, we want to know, okay, we've got these companies to look at. First thing I want to do is say, okay, what do their charts look like? So I've got those all pulled up over here in our charting platform. So starting off with our list, we've got Ford, right? Ford has been moving up, but definitely after a drop, right? So it's pretty low price, $10.33. That's something worth putting in here, right? Stock price, we're going to do $10.33, and that's not a percent. So let's go ahead and make that counting. Um, $10.33. Perfect. So now we got that $10.33. Perfect. But what I really want to look at here is let's go right now. We're looking at one day at a time for each candlestick, and we're looking at a year's worth of data. What I really want to see is 3 years presented in weekly data. So Ford, kind of interesting, but this is definitely a long-term downtrend, right? We can see we're moving down over time. Now, Ford has some good redeeming qualities like a nice, healthy dividend that they pay very, very consistently. And some other cool things like they have a really good options chain. So once you get into doing things like covered calls, that I'm super excited about, like that sort of stuff is really cool with Ford, but definitely kind of in a longer term downtrend, right? So that's good to know, good to be aware of. So that's kind of Ford, right? Okay, perfect. So there's Ford. We know the price. And I know I'm going out of order on this, but that'll make sense here in a minute. We're going to go through and redo. All these are old numbers. So we're going to go through and redo and update the ones that are in here. But I want to put stock price in here. And always, always, always when I'm looking at investing in anything, I want to know what their chart looks like. Right, I want to look for things like, okay, this is pretty stable. So if we go back to a daily, this is actually kind of a little gem that you guys probably don't know. But if I'm looking at the chart, you can see, okay, one day, the next day opens pretty close to where the same day or the day before is at, right? You have some gaps like this, but that's on earnings, right? So that's expected. You have a couple of gaps like this, right? Like here, there are some gaps, but generally this is a fairly consistent chart. Let me show you guys. I think it was BP oil. Yeah. So look at this. This actually just trends really well, or has trended really well. But this is really interesting because you go in tight on a daily time frame. Look at how separated these are, right? It's like big gap, big gap, big gap, and then coming up, right? Gaps up, gaps down and up. And this isn't even the worst one I've seen, but this is just the one off the top of my head that I was like, I know this is a little gappy. But I want to look to see, okay, are companies gappy like this? Because if they've got lots of gaps like this, that can be kind of concerning. Anyway, I'm not focused on that, but you can see in these stocks, right? Hey, nice and tight. Now there's some gaps, right? This is like an earnings announcement, so that's something that's going to be extraordinary, right, compared to normal trading. But like, okay, AT&T. Here's AT&T's chart. Very good, right? Very smooth, very clear. So that's kind of what I'm looking for. So anyway, that's a little nugget you guys probably didn't know that you needed, but that is actually something really important to keep an eye on because it helps you trade better. If it gaps more, then you're gonna have a lot less volume of trading, which means you're gonna have worse things like bid-ask spreads could be a problem. Where like with Ford, the bid and ask spread is usually 1 cent, maybe 2 cents. Like it's never gonna get you. But anyway, there's a little bit a deeper dive than I bet you wanted to go on this morning. So there you go. But next I want to look at KHC, right? So KHC is Kraft Heinz, right? Kraft Heinz company. Again, fairly tight. We got some gaps, but that's mostly like earnings gaps, right? Fairly tight. And this is a 1-year daily chart. Now, this also is downtrend, right? Moving down here over the last year, pretty obviously. Now coming up today a little bit, but definitely moving down over the last year. Looking at a yearly 3-year chart, right? Long-term downtrend again. Again, this does have some cool things to it though, like that nice dividend. Now, companies like this that you see in these kind of long-term flattish to downtrends that pay heavy dividends are often called like cash cow type companies, where they're not really into huge growth, but they pay dividends because they like to reward investors and right, they're just making a lot of money. Things like Kraft Heinz, right? Everybody buys, Kraft Heinz sells so many things, right? It's ketchup, it's mac and cheese, it's Kraft noodles and Heinz ketchup, right? But they sell all sorts of things, and it's like, okay, well, they make a lot of money. They're very stable. They're very good, kind of consistent return type companies. But the downside of that is sometimes you get into these um, declining stocks. Now, there's ways to combat that, but you do see it. So good to know. Back to daily chart real quick because we want to pull our data. So we're right now at 29.54. 29.54. 59.54 on our stock price. Okay, cool. So that's that one. Next, I want to look at AT&T. And we'll switch from doing this company by company, by the way, to doing, actually going into each company. But first, we're looking at the chart, right? So that's okay. AT&T moving up very, very strongly over the last year. I'll do the price real quick, 27.73, 27.73. Perfect. Moving up really strongly over the last year, which is cool to see. The 3-year chart, pretty similar story, right? We were kind of flat for a while, hung out. Well, not flat, right? But kind of fluctuated here for a couple of years. But the last 2.5 years, right? Well, I guess that's basically the last 2 years. We've really gone up from down here around 13, $14, and moved up here. You can see I did a little bit of trading on this for a couple of months in here, which is cool. But yeah, that's kind of AT&T. So now we're in like an uptrend. We're actually looking a little bit stronger. Pretty cool to see. Next up, we got General Motors, right? GM. And GM, if we pull up here, all right, long term, we were flat for a while, right? There was like 2 years there where it didn't get really above this $42 line. Now it's moved above that, and this is a little bit of an unclear one. Looking short term now, if we go long term, I don't want to clear all these because some of this is actually useful, but right, we go kind of a longer term perspective. Like, well, is that perfect? Probably not. But we're definitely moving up for the last 2 years, right? Definitely moving up and looking very, very strongly bullish here this last week. Makes me think it might drop here soon. Just moving like that. Maybe not, but anyway, that's another off topic thing. But yeah, I mean, pretty good little look here on GM 1-year daily. Right. I mean, the last year we've moved up for sure. Got up to a high of 61. Now we're back down to 53. Okay, kind of interesting. Right. So, but nothing too concerning there. Still not too gappy or anything like that. 313. 313 is our price on that one. And then last but not least, we are looking at Main Street Capital Corporation. All right, Main. Perfect. So over the last year, definitely generally moving up, even though we have come down. But the overall market has come down, so that's not shocking. But really pretty solid growth right here, right? And then this one's fun because it pays this dividend. Instead of normally these companies like pay quarterly dividends, this one pays it a lot more than that. So if we look in here, right, you got, okay, January, February, March, March again, right? April. So yeah, kind of cool to see that. But yeah, good looking charts, I think. And then this one was 58.28. 58.28. Perfect. So now we know the price. We know what the charts kind of look like, right? We're in a general, and I actually probably ought to put that in there. There you go. Right, chart pattern. And we're going to do like a 3 year. So we'll say downtrend, downtrend, uptrend, uptrend, and uptrend. And really, I probably ought to say uptrend-ish on this one. Uptrend-ish. There you go. Yeah, cool. So right that way we've got that. We know, okay, quick look, downtrend, downtrend, uptrend, uptrend-ish, and uptrend. Now that's really good to know because we know, all right, well, if it has been doing that in the past, then there's a better likelihood that it's going to keep doing it in the future compared to, right? So if we look at forward, we know that has been downtrending, so there's a good chance that it will continue downtrending versus, right, GM uptrend-ish, so somewhat strong uptrend versus AT&T, right, strong uptrend. And so we can say, all right, well, management has clearly been able to do well. Investors clearly like it. So the stock price itself is moving up, which increases the value of the investment if you're in an uptrend. So that's something I think worth considering. So with that kind of gone through, right, we have prices. We know what kind of the trend looks like. We know what the stock looks like. Now we want to really dig into the fundamentals and say, okay, great. We understand the technicals, at least at a base level. We understand what the price is, so we know what we're going to pay if we want to invest. Now, what does this company really look like? So there's a couple things we're going to look at over here, right? We're going to look at all this fun stuff, but really what we got is market cap, right? Market capitalization or EV and enterprise value. It's just two different ways to measure what a company is worth overall, according to what the market is willing to pay for the stock, right? For the ownership. Then we're looking at beta, which is how correlated this stock is to the overall market, right? To the S&P 500. It's like if the overall market moves 1%, how much does this company move? So, we'll check those. PE ratios, price to earnings. So for each dollar that you pay, what does the company make in earnings, right? PEG ratio, price earnings growth ratio. So it's price to earnings, PE ratio, divided by the growth rate. So then you can say, okay, well, when we consider, the future, what do we expect the PE for future growth to be worth? And then you got EPS, earnings per share. So how much for each share did the company actually bring in? What's the dividend yield, right? How much are they paying out in dividends? Because that's money that comes to us as investors when we own a stock. So that's really cool to see. And then, right, we got the price. Then we got EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It's just a way to measure how much money the companies bring in before considering certain expenses, right? Like interest, taxes, depreciation, and amortization. That's all that is. And then we're looking at revenue, right? So what is the company's actual revenue from 2020 through 2024? And then we have a TTM, which stands for trailing 12-month revenue. So we're going to say, all right, in the last 12 months, how does the revenue compare so that we can see thus far in 2025, are they significantly dropping from what they did last year? So we have some of this data. Now this 2024 revenue, the last time I did this was a trailing 12 months. So I need to get rid of that. But what's cool is now we've got these stay, and then the rest of these we'll kind of check and see what they look like. So we'll start here, just going down the list. We'll do Ford, and let's look at Ford on online. So usually I look at Yahoo Finance. You could look at Google Finance. You could look at, I don't know, Bing Finance or wherever you want to go. But I do finance.yahoo.com because I know the system. That's what they have us use in college. So that's what I do on here. And then we go to search for the company's ticker symbol. We're going to look for Ford. Perfect. And then we can see, oh, perfect. Look at that. There's the price right there. Here's Ford. Lovely. So what are we looking for? We're looking for market cap. And we can see market cap intraday right here. So that'll change all the time, but 40.843 billion. So it's gone down a little bit, right? So instead of 42, now we're at 40.843 billion. Cool. All right. That ought to be capitalized. Goodness gracious. There we go. So we know, okay, the market cap's gone down a little bit. That's just interesting to know, right? And good to see. Market cap's gone down a little bit, right? But the company's probably worth a little bit less. So that's not entirely shocking. Right? Enterprise value, EV, enterprise value. Now, is enterprise value right here? We got market cap, we got beta, PE ratio, earnings per share, and no enterprise value. So enterprise value is a fun one we can go find. Probably here under financials. And right then, so this is cool. So we can see the enterprise statement or the income statement, not the enterprise, the income statement, but we're looking for enterprise value. And I think that was under here, though I haven't looked in a minute, but it should be EPS. See, this I know this has things like our EBITDA that we want. This has things like basic and diluted EPS, average shift, which that's all fine. But I want to see is enterprise value. Oh, you know what? It might be. I don't remember where I found this last time. It might be, yeah, down here under statistics. This is where this is. Okay, so on Yahoo Finance, yep, that's where it is. So you look up the ticker symbol and you just scroll down to their statistics for Ford, right? And we do current, and that's fine. And then we do enterprise value is going right there. And they have market cap as well. And they just do it at the close yesterday. So it's a little different, but that's fine. We'll actually scroll down and use this one so we keep it consistent. So it'll be 40.78 instead of 40.84, right? Which all that change reflects, by the way, is the change in the daily price of the stock compared to yesterday's close. Is what changes that from the current one up higher versus this one. So enterprise value 163.3. So enterprise value has gone up. So that's cool. So we know, okay, 163.3 billion. So we know by that, right? Okay, market cap's gone down, enterprise value has gone up, which tells us that right, people are probably paying less for the stock, but the company has not actually dropped in its intrinsic value. So that's kind of what that's telling. So next we want to look at beta. So beta is going to be up here. Beta 5-year monthly, that's perfectly fine. And we can look at a 1.61. So what that means, all right, beta 1.61, perfect. What that means is that for every 1% that the S&P 500 moves, we're going to move 1.61%. Is basically what that is telling us compared to the overall market. Ford has a little more volatility. It moves a little bit stronger. So then we see PE ratio, right? Price to earnings ratio. PE ratio, trailing 12 months, perfect, 7.06. Wow, that's actually interesting, right? Versus 11.23, 7.06. That means you're paying less for each dollar of earnings than we were the last time I looked at Ford. So that's a good improvement here on Ford. PEG ratio, right? Price earnings growth. Now I expect that will be down here again. Yep, PEG ratio, 5-year expected. Now this is a forecast, but we got 3.29. Wow, that's a big change. Huh. Yeah, 3.29. Interesting. So we're going from 0.59 to 3.29, which means for future growth, people expect now that there's probably less future growth. And I'll tell you what that is because that in Ford in particular is pretty obvious. Probably the same thing will be true in General Motors is the tariff concerns, right? People are saying, okay, well, Ford's probably not going to grow as much because there's going to be tariffs on auto imports and auto manufacturing products. So that's probably what that is. But interesting to see. Next, we got earnings per share, EPS, right? And go up for that one to our EPS trailing 12 months, 1.46 up from 0.96, so 1.46. So that means the company in the last 12 months earning more per share, which means they had good earnings in the last couple of quarters or since the last time that I did this. Dividend yield. So that's another one we can see right here pretty quickly. Forward and dividend yield, we are looking at 7.29%. So good dividend yield up again. Why? Because the stock is a little bit cheaper, right? Which is why, like, if you buy cheaper, you get better dividend yield, which is pretty cool. You get better earnings, price to earnings ratios, and things like that. Which is why people will say, especially some investors will say, "Hey, if the stock drops, like I want more," right? When people panic, that's the time to buy because the stocks are cheaper. I can get better deals for the stock that I want to buy. Price we've already got. EBITDA. Now, EBITDA is under financials. We'll pop over here and grab that. EBITDA right here, and we are looking, I might add trailing 12 months, right? That's what I'm looking at on there. EBITDA. So we're at 14,236. So I will just copy that and see. Oh, yeah, okay, so I did do it that way. So it's 14.236 billion. So 14.236. So earnings have increased, right? That's what they're saying the last 12 months. Now we're going to already have these revenue numbers, but I'll show you where you can see them because they are right up here under total revenue, right? Now you can dilute it and take other things out. I'm just looking at total revenue because it is perfectly fine for the cost of the fundamental analysis that I'm doing. But we can see, okay, 2021, right? Well, there's your 2021 revenue, right? It matches. So that's pretty cool. So we're looking for 2024 and then trailing 12 months. So these ones, I'm just going to copy and paste right out of there. Paste and match destination formatting so that it sits there nice and pretty. And then we can do a trailing 12 month. And what's interesting is that is the exact same as this. Huh. Okay, well, maybe that's not that helpful. That's interesting. It should be different, but evidently it's not showing differently. Wonder why. Showing some of this differently though. So anyway, whatever. We will see if that holds to be true. But what's interesting is, regardless, we can see, okay, so from 2023, there was, 176, now we're up to 184. Pretty cool, right? So that means they're making higher levels of revenue, which makes sense, right? We saw higher EBITDA. So that kind of makes sense. And then we can see, I've got this set up to automatically take this data and graph it right here. So you can see the forward revenue has gone up, right? Which is cool because that means they're making more money year after year after year for the last 5 years, right? That's what that tells us. Sounds pretty cool. So that's forward. And now that we've seen it, we can get a pretty good picture. So we know, okay, we know it's in a downtrend, which we don't like. We know the market cap is plenty high and the enterprise value is high. So really the value of the company is, I would say between the two held pretty consistently, pretty level, right? One went down, one went up, but by pretty similar amounts. And I'm really not worried about the market cap dropping because that just means the price of stock dropped, which is fine. But that's what we don't like about the downtrend, right? Beta looks fine. The PE ratio is good. There are less future growth expectations, right? Which is understandable with the tariff stuff. Dividend yield looking great, right? Very, very high dividend yield. Stock price pretty cheap, means it's easy to pick up shares. And then revenue, right? They're making money over time, which is good to see. So I would say pretty good financial health. Really the only thing about Ford that I don't like is that it's in this long-term downtrend, right? That's really the only thing about Ford that I'm seeing here that I don't like. So that tells me, all right, it's probably a good investment, but I want to make sure that I'm aware that it's in a downtrend and that, like, okay, so let me show you what I'm doing here. If we look at Ford and say, okay, this is our 3-year weekly chart, perfect. When do I want to buy, right? I know Ford is in a downtrend, so when do I want to buy it? Well, I want to buy it at the bottom of the downtrend, right? Because if it goes from the top to the bottom and it generally gets lower over time, which has for the most part been the case, then I know, okay, I don't want to buy at the top because then I'm expecting to lose value. But if I buy at the bottom, does that value hold? Right? If I were to have bought back here, this would have been 3 years ago. If I bought back here, I would have been buying at 1091. It's down now at 1032. Well, I know that dividend would have more than compensated me for that difference. And even with it being a downtrend, if you buy at the bottom, like I could have bought down here, I could have bought down here, I could be buying down here. So, right, what I'm saying is, yes, it's in a downtrend, but it's not a super steep downtrend. And if I buy at the bottom, I'm not going to be super concerned about it. And then there's other things that you can do, right? Like I mentioned, covered calls and things of that nature that are really, really cool that can be done in situations like this to help, again, offset that. So it still may be worth investing in. Especially, if you think the other thing I like to think about is kind of do like a litmus test. Like, okay, Ford Motor Company, good. Their fundamentals look okay. The company doesn't look like it's in huge trouble, barring anything, unforeseen or crazy happening. Do I think Ford is going to disappear? Probably not, right? They're probably going to be around for, the next 5 years, probably for the next 10 years. So anyway, kind of something I like to think through, but Ford looking pretty good, right? So that tells me overall, yeah, they're in a downtrend. So I don't want to be super, super heavily invested, especially when it's, on the higher side of that downtrend. But good to see that, good to see that we understand what's going on. And besides for that, I like the look of it. So all things considered, I'm okay with investing in Ford. I'm okay with continuing that investment. Yep. Craft time. So that's our next one, right? So we got one, move to the next one, and then we'll kind of just do that going through. So I may be a little quicker now that I've gone through one and explained what each piece is, right? We're gonna kind of plug them in, get an overall picture, and see what these look like. So let's start here with KHC, looking for market cap and EV. So and here will come up ticker symbol KHC. We'll see, okay, perfect, KHC. Now we know where this is, right? We want market cap 34.77 billion. So how does that compare? Ooh, quite a bit lower. Not shocking again, because, right, if we recall the KHC chart, right, it's dropped pretty substantially. I was probably looking at it back here last time. So, being that it's, let's say $5, $6 a share cheaper, 5.50, something like that. Well, okay, market cap's going to be lower. Fine, that makes sense. Enterprise value. So now here's the question. 53.31 billion. All right, so the enterprise value is also dropped. 53.3, did I say 53.31? Yes. So enterprise value has also dropped. I don't love that, right? It's not fantastic, not the end of the world, but it does tell me, okay, the stock's worth less. EV didn't just go up, meaning probably there is somewhat less, value in the company ownership in terms of what people want to pay for. So that tells me something has happened. Super concerning? I'd say not, right? Still plenty big, but good to see. All right, so next we want beta. Beta 5-year, we got 0.38. So this one's interesting, right? Instead of being above 1, we're at 0.38, which means there's less volatility, right? Less movement compared to the overall market. Or not less movement, less volatility, less correlation, right? It's not very correlated to the market. So if the market moves 1%, that's going to impact KHC by, a 40th of a percent, by 0.4. So that's interesting to see. All right, PE ratio. PE ratio, trailing 12 months, 13.08, perfect. 13.08, great, right? Perfect. And then we want PEG ratio, right? PEG calls right down here. PEG 5-year expected. Okay, so this is cool. So 0.9. So that means investors are expecting, based on future forecasts, which, truth be told, I don't put a ton of stock in future forecasting, just because you can't forecast unforeseen things like COVID, right? I mean, that had, forget all the political things, that had pretty substantial impacts on what happened in the stock market that year, right? And going forward, and it still impacts shipping and all that fun stuff. So forecasts in the future, I think, have less credibility than most people would give them, but still interesting to see. Okay, well, that's a lot of a cheaper expected growth. You're paying a lot less for the expected growth of the stock, so that's pretty cool. Earnings per share. Oops, yep, I was right. Earnings per share up here again. Earnings per share, 12 month, $2.26. $2.26. So they're earning a pretty good EPS compared to Ford, right? That's what we look at. Is one stock compared to the other, and then what's funny is then you can go from that to looking at industries, right? So you look at Ford compared to GM, right? You look at AT&T compared to Verizon. So you compare things across industries, and that becomes a lot better of a comparison than across these. But that's the way that works. So dividend yield is what I want. Next, dividend yield, we are looking at 5.5%. All right, so the dividend has held steady-ish with the stock price dropping, higher dividend yield. Cool. Stock price we already got, so then we want EBITDA, and if you remember, that means that we are now switching over to the financials. And we can go find EBITDA. And that's going to be 2.716. So that's going to be, yep, 2.716. Perfect. 2.716 billion. So that's cool to see, right? In terms of actually, like, what is the company bringing in earnings? All right, well, we got 14 billion, 2 billion. right? Big difference in the size of these companies, which is kind of interesting to see. And then we want revenue. We've got our 2020 through 2023, and now we want 2024 and trailing 12 month. Which I don't know why they're showing the same. Oh, you know what? Yes, I do. I'll tell you why they're showing the same, and I'll get rid of this other one. Give me a second. I do know why they're showing the same. Match destination, and then we'll get rid of this one. They're showing the same because in 2025, we have not yet had a earnings or a quarterly release of information, right, where they give us new income statements, new balance sheets, new cash flow statements, all that fun stuff, and that's where these numbers come from. So the trailing 12 month is going to show the same as 2024 because the data they have is the 12 months of 2024. So that's why that's going to be the same. So we'll just get rid of the trailing 12 months because there's a reason to have it, and that's what we got. So all right, we can see revenue went down a little bit. So we don't love that compared to 2023. But nothing substantial, right? It's not screaming at me that there's problems. KHC overall, I don't love that the enterprise values dropped. I don't love that the revenues dropped. I do like that the dividend is better because it's cheaper stock. I do like the PEG ratio, and I do like the PE ratio. So I would say still decent to invest in, but again, right, bigger downtrend. Now this is a steeper downtrend too. So I'd say I'm willing to have some of this, but I don't want to have a lot of it, and I want to make sure I buy it at the lower side of that downtrend to I wouldn't even say the best extent possible, to a reasonable extent, right? Like I'm not going to worry that much about it because we still look at long term. Do I think KHC is going to exist? Like, yeah, they sell like half the food that you find in grocery stores. Maybe probably not half, but right, they sell a lot of food. So I'm not worried about them going away, but something to consider. And so maybe be a little lighter on them with the downtrend and just with how steep it is, right? So when I do a fundamental analysis, I always think, okay, fundamentals are important. I also think technicals are important. So it's really cool to mix the two and then see, all right, what's happening. And then, looking at their revenue trend, you can see that's a pretty good little drop there, compared to what they've had, which is actually interesting because that 2024, they made less than they've made any of the 4 years prior, which I actually don't like. So yeah, maybe stay light on KHC, right? Maybe I'll buy a couple shares and not try to go as heavy on it as I might on others. So that's good to know. All right, next up, we got our new one. We got AT&T. So looking at AT&T, right, uptrend. Okay, well, this has been screaming up. So clearly investors are happy with it for the time being. I mean, we've gone, right, in a couple of years up 110%. So that's, big move. All right, AT&T market cap. So we want to find AT&T first. Find AT&T, and then we want market cap, but we're not looking intraday. We're going to come down here and look at the current, which is just from yesterday's close, so that's fine. 196.04 billion. 196.04 billion, and we know there's nothing to compare to because we didn't do AT&T last time, right? In terms of looking at it prior to current comparison. Now, of course, we could look historically, but truth be told, you can analyze until you're blue in the face. But you just don't have to usually, right? You can get a pretty good idea of what's going on just looking at these numbers that we're looking at, right? Graphing revenue. It's not that complicated. Not like it's nothing, but you can get a pretty good idea of what's going on this way. So market cap, all right, enterprise value, 333.66 billion. Well, that's a cool number. 333.66 billion. All right, beta. Beta is going to be up here. Beta 5-year monthly, we get 0.7. 0.7. Okay, so the overall market movement has less impact on AT&T than on Ford, but more than on KHC. Cool to know. PEG ratio, right? PEG ratio. Is that what I'm after? Right? Yeah, PE ratio. I thought so. Thought I'd skipped one. Okay, PE ratio, trailing 12 months. We got 18.61. 18.61. So that means you're paying a lot more, right, compared to KHC and Ford for each dollar of earnings that the company's making. Now, those were downtrends, right, meaning stock price drops. So all of the fundamentals, assuming they stay the same, which of course they don't, But assuming they stay the same, the lower stock price makes these numbers better. This one's been going up. So assuming the fundamentals stay the same, makes these numbers worse. So interesting to see. PEG ratio. Now this one may be interesting on AT&T. PEG ratio, 5-year expected. 1.13. Well, that's actually really good. 1.13. So that tells me that future expectations are pretty strong for AT&T, right? Yeah, that's interesting to see that that's that low. Okay, earnings per share. Earnings per share, trailing 12 months, we got 1.49. Perfect, 1.49. Okay, so better than KHC. Slightly worse than Ford, but pretty close. And dividend yield on AT&T is 4.06%. Wow, that is not as good, right? 6, but not entirely shocking given that it's been an uptrend for 2 years. Like it's been moving up. The dividend has stayed basically the same. Dividend yield is going to go down, and it's going to be lower than stocks that are in downtrend. Right, so that makes sense. All right, looking at EBITDA, that's what we're on, huh? Yeah, okay, cool. So we're on to the financials, and this is the income statement consolidated right into where the information is really nice and accessible. We're at 43 or 44.037. Say 40. Oh, there we go. 44.037 billion. Okay. 0.037 billion. And you can see I did a adjustment, right? Because these numbers, if you look up here, are all numbers in thousands. So actually that means that when we're looking at this, right, if we wanted to really know their revenue actually is not 26 million, it's 1,000 times, right, what we're copying and pasting. So that's kind of interesting to see, and just think about the scale of these companies is kind of insane. But that's what we're looking at. All right, AT&T, looking at revenue. Now what we're going to see is that right, if you upgrade, you can get old data, but you see the last, right, 4 years and it's trailing 12 months, which of course, we just discussed we got no quarter of data yet since 2024. So that's not going to do us any good. So we're going to go, instead of 2020 forward, right, we're going to go 2021 forward on revenue because that's what we have currently available. Now, it wouldn't be all that hard to go find the 2020 revenue, but I'm not too worried about it. So I will just match destination formatting. Right, so we'll just continue and see what we can get looking forward. So we will match destination formatting. Oh, that's cool. Show you guys this cool thing here in a second, but check this out. As I put in new data, it is automatically building me a new graph, right? Showing me what's happening with the revenues and showing me what's happening with the revenues here as well. So we can see from 2021 to 2022 was lower, 2023 was somewhere in the middle of those two. And then we got 2024. Again, the trailing 12 months, we can update once the companies release their new quarter of information. We haven't got that yet. Match destination, perfect. So now we've got that. We can see the revenue trend. Okay, cool. Revenue gone down from 2021, but coming back up some. Good stuff, right? Good to see. So that's kind of that fundamental analysis. Now I'm starting to go through them quick, but I don't want to just do the same thing over and over and over again. So that is what we're doing, but I don't want to rehash all the same points. I know that would be a bummer for you guys. So that's what we're looking at. But overall, pretty good numbers. Now the ones that are low mostly because we're in a downtrend, right? Or in an uptrend rather. So the growth numbers are less strong than if you're in a downtrend compared to similar fundamentals, right? Hopefully that makes some sense. But I really like the EBITDA. I like the revenue, not necessarily for the trend of it, right? Because the trend of it's not awesome. What's interesting is look at the level of revenue. It's very, very comparable with Ford and with General Motors, which have really high revenue, which makes sense, right? AT&T is a big company, and they make a lot of money, which is not to say that I'd be worried about KHC. I mean, they're still making plenty of money down here, and so is Main Street, right? They're still making plenty of money down there to invest in, but right, AT&T is a big company, so cool to see the data supports that, right? They're making a lot of money, so good to see. So that's kind of that one. I would say AT&T. Am I worried about investing in it? No. The dividend yield is a little lower than these guys, but honestly, a 4% dividend yield is still really nice for an annual dividend, right? That can still do you a lot of good. I've definitely invested in companies with 4% and had great results there. So I'm not worried about that. I think, it's in an uptrend, which I like. So one that I definitely would be willing to invest some money in, right? I don't see any problems with it there. So next up, we're going for General Motors, GM. So let's go to GM. And as maybe repetitive as this is starting to seem, it's really kind of a good thing, I think, for me to be able to show you guys this because, right, you're watching me do this. Now, I've done this a whole bunch of times, but you're watching me do this fundamental analysis over and over and over again. So you're getting it in your head. You're going to be able to see it. You're going to be able to look at it. You're going to go, okay, now, if you take this knowledge, you take what you're seeing and you go, okay, let me look at this other company. And you go, oh, earnings per share, EPS, right? Trailing 12 months, right? I mean, I've said that a whole bunch of times when I look at this. TTM, trailing 12 months. Right now, you're going to know that. And you're going to look and be able to say, oh, EPS TTM. That means earnings per share, trailing 12 months. That tells you information, right? And then you can read it and say, okay, good. So in the last 12 months, the company has earned $6.37 per share, right? So that gives you valuable information that you can use to look at, to analyze, to compare it against other stocks, which is just cool because then you can see it, know what you're doing, and get a good idea what's going on. So General Motors, first we are looking at market cap and enterprise value. So we'll come down here to our statistics. Market cap, 52.33 billion. So down a little bit. Probably the company a little cheaper, 2.33, but that is fun. It's $2 billion, but yeah, what do we care? It's not that big of a change. It's kind of funny. Yeah, there you go. Enterprise value, 155.88 billion. So that's up. Right. So just like I think it was Ford, that's not going to concern me. 0.88 billion with the two valuation metrics kind of going in opposite directions, right? You think, okay, market cap has gone down, enterprise value has gone up. But if we equalize that, just we're at the same level. It's not going to be something that's concerning me a whole lot. And they're not that big of changes anyway, relative to what the company's worth. Overall, it's not like a $2 billion change is that big when you're at 50 billion. You expect that sort of thing in business. So anyway, there you go. Next up, we got beta. Beta is up here, and beta 5-year monthly 1.43. That's almost the same. Just down 0.01, and then we want our PE ratio and PEG. So we want PE first, trailing 12 months, 8.31. So that is up a little bit, meaning you're spending more for earnings, right? 8.31. So I don't love that, though it's not the end of the world. And next one, PEG, right? What do we expect for the future? We're at 1.34. That's the wrong one. We're over here at 1.34 compared to 0.52. That tells me that future expectations have gone down, which matches what we saw with Ford, right? We talked about how that was probably going to be the same. Look at that, it is the same. Well, not the same number, but it's the same direction of movement, right? Which makes sense. So that is exactly why, if you look at companies and you want to say, okay, like if you want a good comparative analysis and you find a sector that you like, right? Like let's say you want to do tech stocks, you could look at Apple, Microsoft, IBM, right? I'm sure there's tons and tons of others. But if you wanted to look and say, okay, which one of these is the best? Now, the problem with that is, truth be told, right? Everybody says, hey, what's the best investment? You don't need the best investment. You need a reasonably good investment, and then you need to stick to it. I think that makes a lot more sense because if you try to find the best thing, there's always something better, right? There's always a new stock. There's always a new thing. There's crypto, there's housing, there's tons and tons of different things. Like there's so many options for investing that finding the best would be too much of a effort to be worth doing, right? Hopefully that makes sense. But if you find a reasonably good investment and you say, okay, let's say you got 4 tech stocks that you want to look at, which one's the best? Well, you do a fundamental analysis on them. You look at the technicals and you say, okay, what kind of a picture does this paint, right? What makes sense here? So anyway, a little bit of a rabbit trail, but there you go. Next up, we got earnings per share. EPS is going to be up here. Earnings per share, $6.37. Wow, is it really 63? That seems wrong. Huh. 6.37. Okay, probably it was $6.30. or I have already typed something in there by accident, but $6.37. So probably we're up, 7 cents, not a huge change on that. Dividend yield, 0.91. So a little bit lower, 0.91, which I don't like. No, not 91. It's 0.91. There you go, 0.91. So much lower dividend, which tells me they're still paying one, but right, lower dividend. Now there's pros and cons to that. I like dividends. Personally, I like being able to invest them. I like being able to turn them and do things like covered calls that I've mentioned a few times, right? So I like dividends. There's reasons that people say don't pay dividends, mostly tax wise. And it does tell you something about the company's ability to use its money to make more money. If they're paying you a dividend, then that gives you a higher return than they'd be able to create in the stock valuation, right? In the price of the shares, which is the value of the stock, by investing it back into their own business. So there is some argument for dividends not being a perfectly valid thing, or not even a valid thing. There's some argument for dividends not being the best way for companies to return money to investors. But I like dividends because they put money in my pocket and let me go use that money to invest in that company or in other companies and make more money. So I like dividends. There is some argument against it, but lower dividend on this one. So take that as well. All right. Next, we're on to our Next, we're on to our EBITDA and income statement items. Right, we've got our stock price. We've got EBITDA. So we're off to our financials and income statement and EBITDA 21.754. Okay, so earnings have gone down. Interesting. 21.754 billion. Still perfectly fine, right? Still good earnings. I'm liking the picture of General Motors less than I have of some of the others. Not entirely shocking. It's the lower future expected growth rate that I don't like about it. Mostly, and then also it's a more expensive stock, right? It's a little bit more expensive, which means you get less shares for the same amount of money, which isn't the end of the world, right? But if you want to do options, you want to do covered calls, you have to do those in blocks of 100 shares at a time, right? And so if you think about that, okay, 100 shares at $53, well, that's $5 grand. Oh, goodness, do I really want to pay $5 grand to be able to do that? And not even do I want to pay the $5 grand, like the fine. $5 grand is not the concern here. The concern is, okay, well, let's say we take the same amount of money, you could buy 500 shares of Ford, and then you'd be able to, in theory and in practice, it pretty well works this way, that you can, if you're using options in a fairly conservative way, you can leverage that to make more money faster, to supplement the growth of the stock and supplement everything. So anyway, there's some arguments there. I think not something you need to worry about, right? The funny thing is, if I'm saying things that you don't understand, right? If I'm going deeper into the stock market than what you understand right now, or even just saying it in a way that you're like, okay, I maybe understand what an option is, but like, what's a covered call? Or I understand what a covered call is, but not like, it doesn't really matter. Just take what's useful, right? Don't worry about the rest. You can learn it. That's the cool thing about the market is you can just like look it up, learn it, figure it out, right? Watch courses, watch videos like this one. This is how you learn this stuff. So anyway, there you go. A little tangent for you again. EBITDA. I've had like one of those every single stock. So all sorts of little nuggets of wisdom for you guys to take on this one. So, all right, EBITDA on this one is 21.754. Yeah, that's what we just did. All right, revenue. So we've got our revenues in the past. Now we want our 2024 revenue. Just going to be this guy right here. And we can copy that, we can paste that, and then we can match destination format. Perfect. Okay, so that's cool. So revenues went up pretty substantially, actually, which is cool. So if we look at the GM revenue trend, very, very solid revenue growth. Similar, or same sector, right? They're cars and Ford cars, right? So you see the revenues very, very closely resembling one another in terms of where they're at. And then also, comparatively, like the size, they're almost the same size, which means these companies are making almost the same amount of money every quarter, which is cool, or every year. So there you go. That's GM. I would say generally looks fine. Generally, General Motors. There you go. But generally looks fine. I think the only thing I don't like about it really, there's three things. Fine. There's the low dividend yield because I like dividends. There is the higher stock price because that means you buy less shares for the same amount of money. And there is the the lower future growth. So I don't love that, but it is kind of in an uptrend, right? So that's kind of redeeming compared to Ford. Generally, I like Ford better, but that downtrend is hard to overcome. Now, I think it can be overcome, but it takes more advanced strategies. So let me explain it this way. If I was going to be using things like, not even like, if I was going to be buying shares and buying enough that I could get sets of 100 shares at a time so that I could do what's called covered calls, I would probably be more interested in buying Ford. If you don't know what that is, right? If I didn't know how to do that, I'd be more interested in buying General Motors. Because General Motors is an uptrend, so the stock itself, without the other things that come with it, like the dividends and like the value and the cash flow that can come from covered calls, if you don't have those, then the uptrend is better for you because it helps your value actually increase because each share that you buy becomes more valuable over time, right? So hopefully that makes sense. If it doesn't make sense, don't worry about it, right? You can learn it. And that's yeah, that's super cool. But anyway, there you go. So comparing the two, which one's better? Depends who you are. And that is super, super good to keep in mind, right? Like you think, okay, I've done a comparative analysis on these two companies, right? Which one is the absolute best? Doesn't even matter. What matters is which one is going to be the best for me with my strategy, with my mindset, with my knowledge, with my capabilities, right? So which one can I do best with? That's the question to be asking when you look at these things. So yeah, another fun little tangent for you guys. Hopefully it's helpful. Hopefully some of you guys are going to watch this and be like, whoa, this makes sense. Or, I caught that, but I didn't catch this. Well, okay, let me figure out what option. Let me figure out what covered calls are. Right. I love covered calls. Anyway, off to our next one, I think. Main Street Capital Corporation. So Main, and we didn't even look at the GM chart, but hey, that's what it looks like, right? Going up. And this is what I'm saying, right? Like in the last year, if you would have bought and hold, right now you're up 100%. At the high, you'd have been up 130%, right? Where Ford, if you bought and held, you'd be looking at about there to now you're down 37%. At the low, down 44%. Like that's a big difference, right? I think it's overcomable. Well, I know it is, but there's different people for who each stock would be a better buy, right? Which seems kind of crazy, but that's the truth. So there you go. Main Street Capital Corporation, right? Good little uptrend. See this moving up pretty nicely in the last few years. So let's do our analysis on it. So we want pain. What was that? Not what I want. Main is what I want. And Main Street Capital Corporation. Perfect. Right, 58.24. Okay, that's cool. I wonder. It's down 4 cents from when we looked earlier. Okay, so we're looking for enterprise value and market cap. Market cap first. Oh yeah, enterprise value. This is the one they don't have. Yeah. See, last time I said 5.5 billion ish. There's not really an enterprise value because of the setup of this. It's not a strict company like you would think on most of the other ones. So Main Street Capital Corporation, let's see. Yeah, so Main Street Capital Corporation is a business development company that specializes in equity capital to lower middle market companies. So it's a different company, and because they're in equity, because they do basically they're in financing for business and for like for general businesses. They're basically in financing, and because they're in financing, which is a bad explanation, I know, but because they're in financial services, that means that they have different rules and their reporting is different than it would be for car companies, for phone companies, for food companies, right? It's just a little bit different, which means they have somewhat different metrics that they look at. So enterprise value isn't really a thing. So anyway, take that as you will, but they still got a market cap, right? And instead of what we had before, we're now at 5.23 billion. So a pretty good increase actually from this 4.264, 5.3, oops, not 58, 5.3. billion. Honestly, the EV, I'm gonna just leave because I don't really want to go find it. I'm not really that concerned about it, right? These are just different metrics. We can see this one's gone up. The theorized enterprise value may or may not go up, whatever, doesn't matter. I mean, we've got, the truth is, we got this one. We know it's in an uptrend. We know we can buy it. We know all the important things. I'm not worried about having the second metric, even though I like having it on the others. So I'll change this to 5.5 billion-ish, maybe. Oops, not maybe. So, who knows? Is basically what I'm saying with this. So I don't really know. I don't really care because it's not really a big problem. So anyway, take that as you will. But yeah, financial companies have different reporting requirements, but they do have most of the same ones. And you can see right here, right? Like we got, okay, there is no PEG ratio, right? Like it doesn't exist. So we'll see, we'll see this here in a second. But enterprise value is our next one. Oh no, we did enterprise value. We didn't like it. We have beta. So beta will still happen, right? We got 1.27, so a little lower, but not much. PE ratio 12 months. We got 9.96. 6. So that means you're paying a little more for earnings than you were last time we looked at this. Not the biggest change though. Right, but see, this is interesting. PEG ratio, 5 years 50, like it's just not there. Yeah, pretty interesting. So what you can look at that is things like this, right? Analyst recommendations. Truth be told, though, I don't love that, but you can look at this type of stuff. What I like looking at is, okay, new portfolio investment, extending a credit facility. And those who invested 5 years ago are up 300%. That's pretty cool. Right, looking at these things, you can kind of figure out an idea of what does the public think and what do news people and financial pundits, what do people think of Main Street Capital Corporation in terms of future growth? And does it make sense, right? So I'm honestly just gonna leave that because I'm not really concerned about it. The truth is, I rely more on the technicals for things that are questionable, right? So if you don't know what the EV is, you don't know really what the expected growth rate is. And I said I don't really trust expected growth rate anyway, right? It's just a general indication of where people might be thinking things are going. But I don't trust them that much anyway. And so I look at the chart and I know I can react to the chart. Within my plan, I can react to the chart to change things. Like it's not like I'm just stuck once I buy it. So anyway, I'm not super, super concerned about those on this. So I'll just kind of skip it and keep going, right? Makes life a little easier and it's not going to hurt me. So it's okay. Earnings per share. We've got $5.83. So, gone up a little bit. $5.83, gone up like 50 cents. That's not bad. Dividend yield. So this is going to be an annual dividend yield, right? 7.11%. So that's even gone up, which is pretty cool. That in this case means they're paying higher dividends, right? Because the last time I looked at this was here or here. Probably in here somewhere. Right? I don't really need to hold that on there anymore, but right, buying it in here somewhere is when I was analyzing it. And now that it's come up, it's a higher price. That means your dividend yield, if the dividend stays the same, would be lower, right? Because you're paying more to get the same dividend, your yield drops. So because we're paying more and the dividend yield has gone up, that means they're paying a higher dividend. So that's kind of cool. Kind of cool to see means you get actually higher amounts of dividend per share, which is cool to see. Stock price we've got, right? So then we want to look at EBITDA. So let's go to their financials and see what they've got. Oh yeah, yep. Yeah, see, okay, this is where you have different reporting requirements, right? So obviously I think the last time I did this, I went and we looked at these different sites. So like I could just look up, okay, Main Street Capital Corporation. EBITDA, right? I mean, I can go find it, right? Let's see what's see, this is interesting. Yeah, see, this is not actually what they're showing. Like, because it's a financial company, it's a little bit different. EBITDA ratios aren't really what I'm after. Fourth quarter net investments, right? So it's like, okay, that's fine. It's just not the end of the world. to not have all these, and you can kind of find, I think I might have found, I don't know, macro trends can be a good spot to look. We'll just look really quick and see what they've got. So yeah, EBITDA margin, it's just like, okay. So yeah, it shows it, it's just not quite right. Right. So we can say, okay, EBITDA 0.48 billion. So it's like, okay, well, we've gone up 0.02, right? Like, all right, fine. But it's less reliable because it's not really telling you what EBITDA normally tells you. Like it's just a little bit of a different thing. Um, so I'd say I put less reliance on, a couple of these numbers on this than I normally would. But we can still go back and find um, our revenue, right? So we can get our revenue for last year. And we can see, okay, good, revenue's up. So they're making more money again. And this is kind of cool, right? Over the last 5 years, they've been making much, much more money. So it's cool to see. So main revenue trend, right? Big climb in revenue, which is cool. That's a fun looking little chart. So that's kind of what we're looking at, right? So, all right, if we think about Maine before I, finish up and kind of wrap up here, if we think about, all right, does this actually look like a good investment, right? Is this something I'd be willing to put my money into? Well, okay, we know market cap actually looking fine, right? Kind of went up. Beta, not concerning. PE ratio, it's kind of in the middle, right, of where we've, actually, it is in the middle, it's the median of what we've got between these other ones, right? So that's not concerning to me. The earnings per share, right, not bad. Pretty high earnings per share, actually, I kind of like that. Good dividend yield, really, really high dividend. That's our second best dividend yield, right? And it's been moving up, which means they're paying more dividends over time, which I do like. And then we can see they're making more money, right? Their revenue is increasing. So overall, I think that paints a picture of a fairly healthy company, right? And they're in good uptrend. So truth be told, I like it, right? I like the look. And so for me, that's a fundamental analysis that's going to tell me, all right, watch technicals, pay attention to what's going on, right? Keep an eye on things, but like, good, looks fine. So yeah, there you go. So that's our 5 companies. If we look at our comparative revenue analysis, we can see, right? All right, Main Street Capital Corporation, lowest actual revenue, and it's so low, in fact, we can't see the huge increase that it's had because the number is so much lower than these other ones, which is where it's like, okay, this is interesting, especially to see, our comparative analysis on Ford and GM. I was pretty cool to see, and then we can see our AT&T's less and getting to be more or less, which is interesting. But right, we can see, all right, Ford making more money over time. KHC kind of bouncing around. AT&T making a little less money over time, but kind of coming back up. GM making money over time. Bain making more money over time, right? Increasing revenues. So it's kind of cool to be able to see this and then graphically show it and say, all right, what do we think of these stocks? So honestly, all these stocks, I think I'm okay with. If I want to look and say, all right, which ones do I like the best? I want to invest in Ford because it's low price, because of the cover calls that we talked about, right? I want to be able to show what that looks like. Now, that will take some time, but it's such a lower cost stock that it takes so much less time that it's worth doing to some extent. So I want to do that. I want to invest in AT&T, right? It's a new one that we looked at. Super good uptrend. I like the dividend yield. I want to invest in Maine because I like the dividend yield. Good uptrend, right? These are kind of the biggest things. And if if I like the look of the technicals, if I like what I know how to do with the chart, then I like that. If I like the dividend yield, I like that. And then the other numbers I pretty much use as a indicator of company health, right? So if the company's dying, I'm not interested. None of these companies are dying, right? All of them are looking fine. They're all moving well. They're all doing okay. Now, KHC, I'm a little concerned about, right? With their revenue having dropped so hard the last year. So that might be worth digging into a little more. Or I just take my caution and say, okay, I understand that. I want to be a little more cautious of it. Maybe I'll just invest a little less in KHC compared to some of the other companies. So that's kind of the right. And truthfully told, I kind of like that even without that because KHC's in a bigger downtrend, which I like a lot less, right? Ford's downtrend is a lot more gentle than KHC's downtrend. Obviously, you can tell I kind of like Ford, but I like it particularly because of the price and the dividend. There's some kind of cool things I could show you guys for a lot less actual capital going into this as we kind of build this investment portfolio this way. But those are things for the future that thinking, planning, and all that fun stuff. But it's like, okay, think about, are the companies healthy? Well, yeah, I would say pretty well all of these companies are healthy. Besides KHC, it's not unhealthy, but it's a little bit less healthy than the others, right? So maybe invest in that a little lighter. But generally speaking, these are all pretty healthy companies. They all have pretty good growth expectations from what we can see. They're all doing really well, making extra revenue, right? They're doing fine in terms of revenue. I'm not concerned about the companies disappearing or going bankrupt. Um, and so with that being said, right, that puts us in a pretty good spot to invest in them, to look at what's going on, and right, and to see what we want to do. So that's pretty cool. And then I think, all right, if the company's healthy, if I like the price, right, I don't want to invest in what was it, BLK, BlackRock. I think that's all I can do. BLK. Yeah, right. It's almost $1,000 stock. It has been over $1,000 stock, right? Buying a single share is just therefore very capital intensive. And it's not the end of the world, but like I don't want to buy $1,000 share, right? I'd much rather buy lower amounts of shares at this, $50 range, even the SPY, right? That's why I don't have any SPY yet in this account. Now I do have some SPY. It's a pretty cool index, and you can buy partial shares and all that, so it's fine. But there's some really cool things that I want to be able to show you guys, and that's why I'm looking towards Forge so much compared to some of the others. Is the covered call potential for it, the lower stock price, which means I can buy more shares faster, which means I can do covered calls faster. Like there's just some cool things in there to think about. So it's like, all right, do I like them? Do I like the setup? Do I want dividends? Which I really like dividends. And then do I want to do things like covered calls, right? How active do I want to be in that? That is the sort of question where you decide between a Ford or a General Motors, right? If you're going to be more active and you're going to do things like covered calls, then Ford might be the better call, right? Which is kind of the way that I'm leaning in terms of doing the majority of my investing in this account. But if you look at, okay, I don't want to do covered calls, I don't want to do any active investing. I kind of want to buy it, let it go up over time. I'm not super interested in dividends because I don't want to mess with it a lot. Then GM is probably a better call than Ford, right? So hopefully that makes sense. I don't know. Stuff's pretty cool. It's right. It's a lot of data to put in. It's a lot of things to try to understand and work through. But once you understand it, once you work through it, it's pretty valuable. And you can then say, all right, I have a good baseline of understanding. Now updating it's a lot faster. And right, if you're not sitting here trying to explain everything and you just go, okay, does this make sense? Yes. Good. What's the picture that it paints you? Right. It's a lot faster than perhaps I've shown it to be. Plus, I'm looking at 4 companies all at once and updating them for 6 months at a time. You could look and say, every quarter, every single quarter, they're going to do changes to these income statements. So you can look at revenue, for example, and change it to quarterly and say, okay, look. So they put it out end of this month, right? There's going to be another one end of the month. It's going to come out that'll change quarterly. So you could track it quarterly, or that'll give you an updated trailing 12 months. So it'll still give you a good insight into what's happened so far in 2025. So there's a lot of things that you can do where it's like you don't have to make it such a lengthy process. You don't have to explain it. You don't have to talk through the ideas so much. But I really, well, one, I love doing this stuff. So I'm happy to talk about it. And then two, I think it'd be helpful for you guys, for anybody that actually watches through here to the end of the video and everything. I think this is helpful stuff to look at, right? Helpful stuff to think through. I think it could be helpful to you because I know it would have been helpful to me to know. So anyway, that's what we're looking at. That's what I'm thinking. Perhaps I'll come up here in a little, I'll be like 3 weeks or something. Well, it wouldn't even be that long. What is it, 26? So it'll only be like next week that they'll put out the updated trailing 12 months. So maybe I'll come and put that in and give you guys a quick update on the back end of this, show what it changes, right? Show what sort of difference it makes. But yeah, that's how I do it, right? That's how I do a fundamental investment analysis that gives me a good idea. And then I use that knowledge along with the trends and my charting skills, and then my actual, skills in trading and all that. Like this is how you build a investment portfolio of individual companies, right? Now you can do things like buy the SPY, right, where it's just an overall S&P ETF. Like I said, right, I've got some SPY. It's not like that's a bad thing to do. In fact, a lot of times you're going to outperform stock pickers by just doing that, right? Like 85 or 90% of the time, actively managed mutual funds, which is the professionals, and yeah, I say that not mockingly, but the professionals usually underperform the actual market, and it takes effort, right? And it takes work. I don't think it's all that big of a deal. I like doing it, right? I know if you guys are on here watching, probably you do too, right? So anyway, that's kind of the setup, but that's the fundamental analysis update for the beginning of 2025. I would like to come up and update this maybe in a week or so, maybe a couple weeks, get this an update, get you guys seeing what's going on, and hopefully I'll see you right watching me do the investments, right? We can see I did right for it. I bought one share like last week. Well, no, yesterday. Yeah, yesterday. Bought one share yesterday, right? AT&T bought a little bit, now that's going up. So it's like, okay, cool. Hopefully you guys can come and see how I think through this, see how I walk through it, right? See what happens. And then you can take the knowledge, take the skills, right? I mean, take the list and say, okay, do I like these ratios? Do they make sense? Right? Take what's helpful, get rid of the rest, and hopefully it's helpful for you guys. So anyway, we'll see you guys in the daily stock talk. We'll see you in some videos. And hopefully we'll update this here in a week. But until then, right, as I always say, always remember your financial future is in your hands. It's up to you to figure out what you're going to do, right? Whether you do nothing or whether you go crazy like I do and go into all this stuff with some serious, it's not that intense, but right, you go and understand it, you go learn it. Whatever you do, right? It's up to you, right? It's your financial future. It's your money, your life. So yeah, it's up to you what's going to happen with it, which is sometimes scary, sometimes really cool. Most of the time, it just is what it is. So hopefully you guys have found this helpful. So, yep, your financial future is in your own hands. So go out there, take it, learn something, and figure out what you want to do with it. All right. See you guys on the next video.